Please take your seats. The program is about to begin. Please take your seats. Our program will begin now.
Good morning, everyone. Please take your seats if you have not done so already. Welcome to Bloomberg's The Future Investor, harnessing the technology of today. Whether you are joining us here in person in Atlanta or virtually from all over the country and the world, we are so happy that you are with us. I'm Janet Wu, a Bloomberg anchor and reporter based in Boston, where I interview the entrepreneurs, the inventors, the investors of that innovation hub. Recent studies show that Gen Z and millennials are earning more and investing at a higher rate than previous generations. But this new class is also getting their first real test of volatility and a market downturn. and also all the different changes that are happening daily with what the Fed is saying and also the different investment classes. Whether their investing potential, no matter what, coupled with the pace of innovation, is set to be exponential. Whether you are investing for them, with them, or as them, younger investors will have a major impact on society and the world of finance. At the same time, with all this volatility, they have a lot of questions, and that's some of what we are going to be looking at today. They are a growing force in finance, and we want to make sure that we understand what they are thinking. Today, we'll take a look at a few things: how they are consuming information with trends, sectors, and asset classes, what also they are finding most attractive in these market times. We'll explore the technologies that they are embracing from both a consumer and an investment perspective. And also, we have something special for you today. Bloomberg Intelligence will take us for a drive across the electric vehicle market so you can see how that technology is changing both how we may invest, how we will drive, and how we will live. We also have a great panel focused on adding value in your portfolio through all kinds of tech and innovation, no matter your age or your experience. Before we get started, a couple of announcements for you. I would like to acknowledge our presenting sponsor from US, Invesco QQQ. You will hear from them later in the program. For our virtual attendees, if you experience any problems with your video or audio quality, try doing the old-fashioned thing first. Just refresh your browser. You can also use the chat box at the bottom right corner of your screen for support anytime through this program. We want you all to participate and to ask questions of our panel, and we will try to get to them as many as possible. To do that, please just scan the QR code that you are finding on your badges today. We will also flash it on the screens occasionally so you can access it that way. We also want you to engage with us on social media because we are, of course, talking about the newer investor classes, and they are very hip with technology. To do that, please just use the hashtag #TheFutureInvestor. You can also follow along with the day's highlights with that hashtag. And we will be sharing highlights and engagement using our handle online at Bloomberg Live. Feel free, and we encourage you to tag us as well. And with that said, let's go ahead and dive in because we like to be efficient with your time. Please join me in giving a very warm welcome to Jeff Busconi, Managing Director and COO, Bank of America Private Bank, Christopher Larkin, Head of Trading and Investing, Etrade from Morgan Stanley, and Brittany Bowles-Moeller, Southeast Region Head, Goldman Sachs Private Wealth Management. All will be in conversation with Brett Pulley, Bloomberg's Atlanta Bureau Chief.
Hear me? Okay, great. Well, welcome. Good morning. Welcome to the mindset of the next gen investor. Jeff, Christopher, Brittany, welcome. Thank you very much for joining us. We'll get right to it if that's okay. Great. Brittany, you lead Goldman's efforts to attract and retain the next generation of wealth owners. It's fascinating. How does a giant firm like Goldman do that? And who is the next generation? How do you define them?
Thank you for the question, Brett. And by the way, hello, everyone. Good morning. It's great to be with you all. If you don't mind, maybe I'll spend just a moment on what is private wealth at Goldman and then get right to the question. So if you know about Goldman, we're one of the largest wealth managers globally. Within private wealth management, we specifically focus on clients who have 10 million or more of investable assets. Many of our clients have multiples of that. We speak to every client and really serve them in a very unique way. But overall, our goal is to help our clients maximize their impact of their wealth through really bringing investment strategies and opportunities and thought leadership using the whole breadth and depth of Goldman to bear. And maybe I'll take the definition question first, if you don't mind. You know, future investor, I actually love that title. Some define it as millennials, Gen Z, next gen is a common term. I think in wealth management circles, next gen has come to mean really inheritors of wealth. And what we found at Goldman to be tremendously beneficial is actually to think about this important investor base as being inclusive of both inheritors and wealth creators. What we found from speaking to our clients is really how they made their wealth, how they came to own it, is much less important than what they plan to do with it. So their future ambitions, how they make decisions, their preferences, what they need from a firm like ours is much more dependent on their life stage, really, than how they came to own their wealth. So definitionally, we think about this important group as both creators and inheritors of wealth. And to your question on how does a big firm like ours think about this, a little bit of that implies, I think, a common misperception, which is, you know, don't you have to have hundreds of millions of dollars today to be a client of Goldman? And really, I'd say it's our job to make this important group understand how important they really are to us. So we actually really invest very early in these relationships. And I'll give you examples on each. As an inheritor, maybe you've actually been a client of Goldman for decades through your family. Well, we understand that you have an active choice to make yourself about what firm you want your family to work with on a go-forward basis. And so we, again, invest very early, bringing the full resources of the firm to bear for that inheritor client to make sure that they have the ability to choose us as their provider. Same thing on creators, right? We are increasingly getting to know founders of, as an example, high-growth tech companies at the earliest stage of business development. And really, Goldman's really well suited to serve them in that business growth in and of itself. So capital providers, research to help them scale their businesses, certainly how to structure their company from a tax and estate standpoint. And the goal there is really that we've built enough trust and goodwill over time such that when there is a liquidity event, we're the only firm that they're ever considering. And both of those groups are attracted to the same set of platform considerations. So they want a broad network and a highly active ecosystem of like-minded peers, and they want the firm that they're choosing to provide that for them. They're looking for, obviously, a modern investment platform. They're looking for a team that is the right fit, and importantly, that delivers this high-touch, high-service, person-to-person relationship, but with a digital overlay. Always a digital overlay for this group. And then finally, I'd say education is critically important. So we focus on those pillars in our strategy to help attract and retain that group of clients.
In what ways are you seeing those two groups evolve or change over the years? Are they becoming different, more diverse?
Yes, absolutely. So we would say, you know, and research says this too, what we found is that this group is more digital, more diverse, and more demanding. And I say demanding in a good way, so I'll explain that. Certainly more digital, and this is a population who understands exactly what we mean there. Millennials and Gen Z are mobile first. If it's not all on your phone, you're losing that battle. And I'd say importantly though, they still want this high-touch, person-to-person relationship, but they expect that to be complemented with a very high-quality digital experience. Certainly a more diverse population. Y'all know the stats. 4 in 10 millennials and Gen Z identify as racially and ethnically diverse. Women now control more wealth than ever, and that's only growing. And actually, you know, another stat, tech billionaires are now 10 years younger than they used to be. So the group is more diverse as well, and what they're looking for is teams that represent them. So they want the people that they're working with to reflect who they are as people. And then when I say demanding, I think this is all about technology, actually. They want hyper-personalization. They want access to information seamlessly. They want simplicity. And again, they want that delivered in a way that feels like every other application that they're dealing with in the world.
Yeah, great stuff. Jeff, as the head of private bank services at Bank of America, you guys have gathered some fascinating insight into how young investors view the marketplace today. How are their views of traditional assets like stocks and bonds and stuff different than earlier generations?
Yeah, sure. Thanks, Brett. And good morning, everyone. It's great to be here with you. So as Brett said, we recently conducted a study of wealthy Americans. And The interesting thing, Brett, is this was not necessarily constructed as an intergenerational wealth survey. It was really a survey focused on the needs and preferences of ultra-high net worth households. But as we got the data back from the survey and started to study it, what we found is actually some really stark delineations along age lines. And in particular, as we looked at the respondents ages 21 to 42, we noticed some real differences from the rest of the population. And I'll talk maybe just about a couple of those insights. First, 75% of respondents ages 21 to 42 do not believe that it's possible to achieve above average returns with a traditional portfolio of stocks and bonds. So they expressed a much higher preference in utilization of alternative strategies, private market investments, perhaps other real assets, real estate, art, things like that. Second insight was really around sustainable investing. What we found is a similar percentage, 75% of respondents in this same age cohort utilize sustainable investment strategies. And that compares to a much lower percentage in the older age cohorts. So when we look at the data and look at the growth in sustainable investing and the interest in that area, it's really being driven by this millennial population. And then the last area, maybe not directly related to investments, but what we found is this generation is increasingly thinking about philanthropy as part of their overall wealth and investment strategy. They want to have an impact. We call it giving while they're living, but they want to have an impact now. And they think about their philanthropic impact as an overall part of their wealth and investment management strategy.
It's interesting. So this class of investors in earlier generations was not as conscientious about philanthropic endeavors early on. Is that right?
I think that's true. I think, again, increasingly what we're seeing among our clients is they want to have an impact now. It's not just about wealth preservation, but it's about creating an impact now and seeing that impact.
Yeah.
And what we see among our younger clients is deep passion around some of the causes that have risen in our collective conscious, perhaps over the last couple of years: racial, social justice, climate, emotional wellness. And so they're supporting causes that may be a little bit different from the causes that their families may have traditionally supported.
Yes.
Yeah.
Interesting. Christopher, Etrade has evolved a bit in recent months, and I guess at the same time that this market of young investors has certainly evolved and grown. What prompted so many young people over the last year or two to become active investors? Who are they, and how have you guys adjusted to meet their needs?
Yeah, so I mean, when you think about this idea of us evolving, like we're constantly evolving. We've been a digital-first firm for obviously the inception of time back in the basically the mid-90s. When we placed the first online trade for an investor, placed their first online trade. And as examples we go through there, we built the first mobile app for investors to place a trade online for the Apple phone. We did it for BlackBerry. So we've been part of this digital world for a very long time, and we've had to constantly evolve. And there's these different points in time in the online brokerage world where there's these pivot points where we've had to kind of change our model a little bit. Now, the example back in 2008 when there was the financial crisis, where a lot of clients were coming from full-service firms who felt that their broker was not helping them in any way. And so they came to us and looked for help, and we had to pivot our model because we didn't really have the right products for those clients. So, an example, we come back and we now have, managed products and things like that to fit the needs for some of these investors that were out there. So we made that pivot point. And then you kind of fast forward today, where there's always like little mini pivot points. But obviously in 2020, a big pivot point was the entire industry basically going to $0 commissions. Young investors are very cost conscious. And so as you see that pivot amongst the industry, we saw a really big influx of clients starting to come into the door to participate in the particular market. And if you think about it, like, $6 a trade, and I think a lot of us are like, it's not that much money, but it is if you're trying to invest $100 in the market or $500. We serve clients whether you've got, $100 or we've got people that have multi-billions that are sitting on the platform. So how do you serve them? And so that was the start of the growth. And then the accelerator started to become during the pandemic. Where people from home, there was people getting checks from the government. They start to invest their money, and then we had the meme stock. I'm sure everybody's familiar with the meme stock craze, where we saw explosive growth that we've never seen before. And so we prepared, just to give you sort of some context to that comment. It was in Q4 of 2020. We were doing just north of just about 300,000 trades a day. About 3 months later, I think it was basically in February of 2021, we were hitting days of doing over 2.5 million trades. So as you think about our pivoting point, one example is, how do we have our systems handle the massive growth that we saw? That was a really sort of quick way. Not many people build their systems to handle that type of growth that we had. So we've had to do a lot on our side. The industry has had to do a lot to be able to handle those particular things. And then as an example of the younger investors, during that time, as we were getting this growth, we got it across all of the different generations that were signing up for new accounts. But we had, for example, for Gen Z, 300% quarter-over-quarter growth that was happening. So we were really seeing it on the younger generation. So how do we pivot? So these clients, how did they invest? I mean, it's a good question about you go, what are they looking at? And even during that period of time, think about sort of just social media. So we didn't have, when social media was sort of just a place where people were going around, but from financial services, it wasn't really a place that people were going to. That's completely changed. Younger investors are relying upon social media and other folks to get information, recommendation, education. So just think about that part. So we've actually made some investments in our platform to help them when it comes down to social media. So these are things that we've had to pivot from our side, from a digital experience, is that things that we never thought of before have come to fruition with this new group of investors. So it's a really, really exciting time for these young investors. And for us, just the way that, we've talked a little bit about digital first, and I think everyone's pivoting in some ways, and it's really the strategic reason why Morgan Stanley bought Etrade is, how do we get to the younger investors? But how can I serve them from a digital perspective? The world of just going back, I think from a financial advisor, I think we've all agreed that you can't just have a white glove experience and just shake their hand and expect them to come in. The younger generation is just not interested in doing that. So how do we serve them all digitally as an industry to make it a much better experience?
Yeah. Talk a bit about how do they consume information? It seems to me, I've been fascinated. It seems like young investors are just so much bolder than earlier generations. Earlier this year, I was on the golf course, right, with some guys, and there are a couple of caddies out with us. So one of the people I'm playing with, he starts talking about Rivian's IPO is coming up. We get about 2 holes down the course, and one of the caddies say, "Yeah, I just bought some." While we're walking down the course, this young man who's in his 20s. I mean, there seems to be a real, not just awareness, but this kind of bold, kind of brave interest in being investors. How do they consume their information?
Well, I mean, I think, again, over time, as you've seen this, I think that you start with the media around financial services is quite large. Bloomberg obviously being a big part of that, places like CNBC, these are places where you can actually get a lot of information. And everybody's systems have come up to the point where you have so much information at your fingertips when you come into a place like Etrade. You've got education, you've got research, you've got tools to help investors make really good decisions. And so the tools include mobile. We talk about this mobile first. 67% of our logins in a given day is from a mobile device. So it's primary almost against, it's come to the point where it's primary for almost everybody. It's table stakes to have a really good, rich platform. But they're consuming this information. Like I said, I kind of bring this social media. We've got this new thing, but you've got to change the way that you speak to the younger generation. Another good example is news, if there's some really great news outlets right now. It's quite dispersed. If you take a look at some of these things, like Morning Brew is a good example. It's a summation every day of what's going on in the financial markets, but they do it in a way where it's not boring and they make it fun. And typically, if you read the Wall Street Journal, young investors are not reading the Wall Street Journal. It's a little too boring for them. They want to have something that's a little bit more personality to what you're doing. So how do you create that particular personality? So that's a big thing. And then I think for us also, is for these younger investors, and for us to serve 5 million clients or households in our area, how do we serve them? How do we use the data that we have to personalize the experience for them? I can't call 5 million people. People do call us, but they traditionally want to interact with us from a digital perspective. It's 99% of the reason why they're at Etrade. But how do I get to learn more about them in a way that I can create a personalized experience online where it feels like we do have a one-on-one experience? So we continue to find ways that we're not there yet, but I think that we're all trying to find a way. How do we actually literally find a way to connect with younger investors in the way that they want to do it, not the way that we traditionally have done in the past?
Yeah, it's interesting you point out that they're more interested in personality-driven stories. I can tell you when I was at the Wall Street Journal years ago and we really started personifying stories, the old-timers were responding, give us just the news, just the facts. But that's interesting to hear that things have evolved for young readers and young consumers. What trends and sectors are most attractive to this newest class of investors? Brittany?
Yeah, happy to start. And by the way, Jeff, I think you hit a lot of these. And our research, and I think what's broadly written, has been our personal experience too. So we actually had clients together in Aspen, this young investor profile, and we asked them, we said, what do you want to learn more about from an asset class standpoint, and where are you looking to invest more actively? And by far, number one, not surprising, 80% responded alternative investments. So private equity, private credit, private real estate, they both want to learn more about alternatives and invest more of their allocation in alternatives, which goes to your point, this is a more risk-seeking demographic. They're looking to add risk and to do that appropriately, but to look to learn more about that. Second, and we hear this all the time, sustainability and ESG and impact investing. And that really is across the gamut. It could be climate change, social justice, corporate responsibility. But what I find really interesting is that now we have clients or prospective clients actually coming to us and saying, what are you doing, Goldman Sachs, to help further what I care about? And so our Office of Corporate Engagement and our efforts there, which are really meant to do a lot of good in the world, also prove to be helpful in saying to our clients, we're aligned with your values also. And then the final category I would mention is non-traditional assets, so art, collectibles, yes, crypto. And I would totally agree. The ethos of the trader is back. And so having thematic, timely, actionable research that someone can act upon either on their own, on a digital platform, or through their team is sort of a new evolving trend that we see a lot.
Yeah. Jeff, what's the most or some of the most under the radar asset classes that these investors should be thinking about going forward?
Well, I actually think Brittany just hit on really the highlights, and I would totally agree with you. It's what we see from our clients, and of course what the survey showed. It's been about alternative investments, private markets. The private markets we all know and have grown exponentially over the last 5 years plus. So we see a lot of interest there, and question is why? And when you think about this younger generation of investors, they've come of age during a period of extreme innovation across all dimensions of life. And so I think what we're seeing is a greater willingness to embrace innovative forms of investing, to embrace new technology from an investment standpoint, and maybe a little less trust in more traditional asset allocation and portfolio construction. One of the other interesting things from the survey, just around art, to pick up, Brittany, on what you were talking about, 60% of these younger respondents in our survey had purchased a piece of artwork in the last 12 months. So we, again, increasingly see art actually as an investment asset class for this group.
Great. There was a question from the audience. I think you may have seen it, Brittany. asking, how do you create value for people who are below 10 million net worth? How do you create value at that early stage for those folks?
And by the way, this is what we do all the time. So I think that that's, again, this misperception that you need to have, extreme values of wealth to talk to us is just not true. And this is really where we think we build a lot of trust and goodwill so that we can be the provider of choice when someone comes to that decision. So it really is very different for each client. I'd say on the front end, a lot of the work that we do is actually helping someone maximize their tax planning, which has nothing to do with investing, right? It's a completely advisory service that we provide to prospective clients to help them think about how their assets are structured and really how to do that well, because you can certainly have a much different outcome if you've done some thinking there. I think also we play the role of chief education officer. There is so much information out there, and there's a lot of misinformation out there also. And I think really this demographic is looking for a very quick, credible answer to their question. And we end up being that source of education. And that could be, by the way, on a weekly basis. We might be talking to some of these people thematically. What is alternative investing? How do you think about asset allocation? What is risk management? And really setting up an educational program for them and their families. I'd also say one of the things that we've seen different with this demographic is they're very focused on having everyone in their family have a relationship with us. So it's not just one point of contact anymore. And this really is heavily focused on involving the spouse. So we just did a survey where we heard that 38% of our women clients are heavily involved in decision making. 41% are somewhat involved, and only 22% not involved at all. That is a very different number than in prior generations. And so again, in terms of thinking about how we add value, it's helping bring the whole family up to speed and what is wealth management and how do we really add value. If you're a founder of a company, there are a whole suite of services that Goldman Sachs provides to help you capitalize your business, scale your business, take your business to the next level. And that's certainly something that we focus on for those individuals too.
Yeah, it's fascinating. Christopher, your customers are bigger, broader group of folks, I would think. Are they more sophisticated about this stuff coming in than they've been in the past?
There's no doubt. I mean, I think that the education, I think the young investors that are coming out of college today, I think, every year I think the bar does go higher for the education. So they've come in with a lot more knowledge than when I graduated college, Villanova University back in 1991. I didn't have even close to the amount of knowledge that anybody probably sitting in this room has. So we started in a much better place. And so you talked about just before even this idea around sort of under the radar types of products. That, a really good example from my side is options. So options is a big part of our business. Upward to 40% of our trades in a given day are with options. And the highest growth rate is in the younger sector. And they come out, that was something typically where someone would come out of college. They're just trying to learn what a stock or a bond is. And they eventually would learn about some of these more sophisticated types of products that are out there. But when you have something like a product like options, that's one of the most versatile things where you can trade them really in any types of market. You can use it to protect your positions that are in your account. You can use it to generate income. You start teaching people about these types of products out there. You're doing it in a much different thing. So they're much more educated. And the education that we're providing, because it's in our best interest to make sure that all of our clients are as successful as they possibly can be, the education that we provide for free for our clients is tremendous. We've also had to pivot that. Back in the day, it was like we would do a seminar. We'd get in a room like this. We'd get 100 people in the room. We would teach them about investing and trading. That evolved into sort of web seminars, and you'd have a web seminar once the digital revolution started. They would spend an hour and go through an education. Now we got to do things in bite size. The attention span of, I think, all of us has become a lot shorter. So how do we provide sort of bite-sized types of information to clients? Any way we can, and I do that in ways where people can sign up and look at it. I can do things where I can connect with them through push notifications and stuff like that. How do I communicate and let them know what's happening each time? But it's getting shorter and shorter to get the attention span of everyone. We're all very busy and connected in so many different ways. So it's a challenge for us, but one that we continue to find ways to just connect with these folks, from a personal level.
Yeah, Jeff, what about you guys? That's related to the question. that we have from the audience. What is the desired frequency and method of communication?
Yeah, so what I would say is it's really up to the client, and it's our job to meet the needs of the client in terms of how they want to be communicated with, when they want to be communicated with, and the frequency at which they want to be communicated with. And we see, it runs the gamut. But with this younger generation of investors, as we've been talking about, digital, mobile, that's table stakes. Making sure that, we can enable them to do what they need to do when they need to do it through our mobile app. That's a prerequisite. And then, in our case, we've got the client team there as well, and we take really a hybrid approach, a high tech, high touch approach, to this generation, and it really varies depending on the client. Some of our clients want to talk every single day, multiple times a day. Others, a quarterly check-in is sufficient. And it's really our job to understand the needs of the client and meet those needs.
I just want to add one thing. I think for all of us, the holy grail is I don't think the frequency thing is a difficult one to kind of to think about. But to me, it's about the quality of that interaction. So I think for us, we know a lot about our clients. And so when we want to have some type of a touch point with our client, whether it be a phone call or a email or whatever it's going to be, it's got to be a relevant conversation. I need to know if I'm going to present something to you or educate you on some particular thing. I think if you're going to receive and open that or have the right to open one of these communication points, it's got to be relevant to me. So I don't want to just blast. The idea of just blasting an email to 5 million clients and hoping that they open it up to sell something is kind of over. So we're becoming much more intelligent, knowing a lot about our customer, and make sure that's done. From both their sides, when you're in this high-touch business, it's a lot easier to do it when you know a lot about your client. In a digital world, it becomes a lot more difficult. So that is, for us, we continue to find ways to know our clients better and present quality interactions versus like a frequency thing from our side.
That's great. Are you guys seeing this group of young investors take a more active stance in governance issues at all?
Oh, by far. I mean, if you look at the board involvement, getting involved in sort of civic organizations, it's very much, now I don't know that it's actually different than prior generations, but this is an actively focused group, and they're looking to, again, they want to use their investment dollars for good. And so they're consuming, by the way, in a way that is aligned with their values, and they're also investing in a way that's aligned with their values.
Terrific. Great. Well, thank you. Really appreciate it from all three of you. Thanks very much.
Thank you, Brett.
Thanks, everyone.
Thank you.
Thanks again to that excellent panel. We promised to take you on a cool drive this morning, a drive of the future. And for that, please welcome Senior Automotive Analyst Kevin Tynan for Bloomberg Intelligence.
I always feel like the hardest part of the presentation is getting on the stage without tripping. So I'm home free, right? So thank you, and thank you all for being here. I am the Global Director of Automotive Research for Bloomberg Intelligence. So although this presentation is really about the auto industry, which has been disrupted, obviously, coming on about 10 years now when Tesla introduced Model S, I think the lessons that we're seeing now are relevant for other industries, even if you don't care about the auto space, and I'm not offended if you don't. And I remind you that on your badge you have the Q&A code. I'm probably not going to get to your questions, but I did get one that was kind of interesting, and I think it underpins my point here. And the question that came in is almost like I wrote it myself, but I didn't. One company that you expect to be the leader in disrupting the EV space. which is interesting. And remind me that I left that there. I don't want to leave my stuff behind. So the industry has already been disrupted. And if I'm reading the question right, it's an interesting point that the disruptors are due for disruption. And I'll walk through who I think that's going to be. So I didn't really intend to answer that question. I'm not going to pick stocks up here, but we'll get to some of that. So Bloomberg Intelligence is basically a sell-side firm within Bloomberg. We're not reporters. We're not journalists. We are actual analysts. I came from the sell side for a dozen years, top stock picker for automotive and automotive parts, and was there at the beginning of Bloomberg Intelligence, which was originally called Bloomberg Industries back in 2009. All right, so let's get into it. So Tesla, so this is the market cap chart for Tesla, and even though it looks like, can I get my thing in one of these instead of time in both? Sorry. Just so I don't have to keep turning around. So if you look here, right, it looks like Tesla went crazy at the beginning of the pandemic, which is like January 2020. But that blue line is actually General Motors. And also another housekeeping point. If the slides, some of them are busy, but really don't worry so much about them. And if you want the slide deck, I can send it to you after. Just see me hanging around here and just give me a business card. I'll send you the presentation. So if you look, Tesla's valuation surpassed General Motors somewhere around 2017. It's back, let's see, we'll use the laser, somewhere around 2017. So think about that. And at the time, Tesla produced and sold globally 100,000 vehicles, and General Motors sold 9.6 million vehicles, yet surpassed it in valuation, right? And obviously, let me just go back, and obviously we see what's happened since November of 21, which is the same thing that happened to Lucid. That valuation got up, above $90 million. General Motors would typically be in the $40 and $50 million range. So you have Lucid with a market cap almost double as General Motors, 6,000 units this year, right? So this was they had put out forecasts that were much higher than 6,000. They've reduced those. Right, so you have a company producing 6,000 units globally. That's double the valuation of General Motors. And Brett talked about Rivian. I would imagine you'll see that caddy on the golf course next summer. Probably not retired, especially if they bought it. Well, unless they got out right away at the spike. But a $150 billion company this year, they're going to do maybe 25,000 units. So we get these crazy valuations, and maybe I shouldn't call them crazy, maybe they're justified, of EV companies, I don't know, ESG, technology companies, whatever you want to call them. But look, here's the group since November of last year, right? And those guys in green are the pure play EV companies, right? So we've seen some pretty dramatic declines in the market cap of those companies, which goes back to that original point. Like, is it time, right? All those three charts tell me, might tell you something different. They tell me, like, we missed it, right? That peak, which was November of last year, is probably over, right? So these companies starting to be disrupted. Now, let me just make a quick point on adoption and the government role in this, because I get this a lot, There'll be more charging points, and there'll be the Inflation Reduction Act, which will drive adoption of EVs in this country. And you can see we're the white line in this country. We're just about 6% battery electric. This doesn't include hybrids. This doesn't include plug-in hybrids. This is pure battery electrics. So we're behind Europe and China. And here's why, right? And don't worry so much about this slide. That red line is kind of what's important, but that is what BYD got from the government, the Chinese government, as the government wanted to push EV adoption. That is $44,000 per vehicle, right? So BYD is producing EVs in China. They're losing money on them. Government says, no problem. We'll make you more than whole. So over that time, call it 2013 or so, $1.3 billion to one company in direct subsidies from the government. And that number now is about $15,000 per unit. So not so worried about that. But so let's talk about what the U.S. government is doing with the Inflation Reduction Act. And really, to lay the scenario out, we give federal tax credit if the consumer even knows what that is and has a federal tax credit. It's 1 year, there's no carry forward, and it only offsets your federal tax bill. We have the government investing trillions in infrastructure. But if I'm an automaker losing $10,000 to $15,000 per EV, what do? Well, I just don't make them, right? So you can have your federal tax credit, government can invest in infrastructure, but as an automaker, if I'm losing money, I just don't make them. And that's why we're 6% here. We're not 6% here because we can't figure out, automakers can't figure out what Tesla does. Tesla has some magic formula. There are competitive advantages, some legitimate, some the fact that they can lose money year over year and still raise capital for free is one of them. But ultimately, the IRA will get interesting, I think, in 2024 when the tax credit, and I have to do a little bit more research on this, but the tax credit might turn into a tax rebate at the point of sale. Very important, and here's why. Because if you're going to, as a buyer of an EV, if you can find one you like, you will get $7,500 federal tax rebate right there. The credit, you don't even know if you're eligible until you file your taxes the next year. So what happens is that you get your $7,500 at the point of sale. The government says to the automaker, hey, why don't you raise your price by $7,500, and we'll just basically pass that money from the consumer right off to you, which is what happens basically in China. So conveniently, you start to see, as the IRA was being discussed and passed and all laid out, you get automakers raising prices conveniently by $6,000 to $8,500, right in the range of what a federal tax rebate would look like. So essentially what we have now, and honestly, this is the right way to do it. We have the government, for lack of a better term, laundering money through the consumer to the manufacturer to make them whole or closer to whole on EV, money-losing EVs. We haven't had uncompetitive EVs in this country because we can't figure out a good EV. We've had uncompetitive EVs in this country because they're unprofitable. Okay. So blame it on supply costs, or blame it on chips, whatever you want. The fact of the matter is, until they're making money on it, we're not going to get a full effort on EV. So here's the other thing. We'll do this. We were talking about it last night. Some misconceptions in the EV thing is that EVs, Tesla has better gross margins than everybody, and they direct the analyst's eye to two things, gross margin and deliveries, which they push deliveries at the end of the quarter, and they always talk about their gross margins. And this has nothing to do with the regulatory credit sales that they get, which are essentially cost-free. So what we know about EVs, right? Simple to manufacture, the factory is totally automated, fewer moving parts. So you would think that the EV makers have the top gross margins. So you would think that that would be Tesla, Lucid, Rivian at the top there. It's actually not, and it's hard to see, I get it. But that's Ferrari. They have more creative accounting. So their R&D expense is below the gross line. Everybody else, R&D expense is in their cost of goods sold. So all the new disruptors basically take that expense, they put it in the operating line and say, look at our gross margins. So actually that's Tesla in the mix of global automakers at the gross margin line. That's the other pure play, and there's NIO. I don't have Rivian and Lucid on this chart because that's their gross margin profile forward, right? So they're not even on they don't make the list because they're still negative. And the amber lines are actuals. The other two sort of grayed out lines are forward-looking. So we had 2 more years of unprofitable EVs at the gross line before we start to even think about these companies being competitive profitability-wise. All right, so the other misconception, right? Fewer moving parts, easier on raw materials, but the fact of the matter is, and these are all the things that go into an automobile, that's actually electric vehicles. That's the batteries and the materials that go into an EV, 6 times what an internal combustion vehicle would be, right? So we a lot in ESG, and don't get me started, we look at, and I say we, the media, investors, analysts, one small part of the process, the tailpipe, or that there's no tailpipe, but we don't look at, some people will go well to wheels and say, well, how are you generating the electricity to power an EV? And I'm saying, let's talk about how we're mining the materials that go into the EV in the first place. And then let's take that all the way to the end of life and talk about what we're doing with batteries after. Nobody talks about that, and I think we're starting to, hopefully. I think it's a more legitimate and transparent discussion. So who controls those materials? And I know this is impossible to see, but what you need to know is those red lines are China. So all those materials that go into the EVs, this didn't just happen. This is decades of actually positioning themselves to control the materials in terms of EVs. So the idea that battery costs come down, or maybe there's some technological breakthrough that makes some other use that we can be competitive. But right now, this is where we're going to get materials. So here's an example. Lithium carbonate, cost per vehicle. Lithium carbonate is the raw material that goes into the battery. None of the other stuff, just the raw material. So back, way back at the beginning of COVID in 2020, for a 60 kilowatt battery, which is small, we were talking about $10 per kilogram USD. Now it's, as you can see, it's up close to 80. So the input of that raw material back just not even 3 years ago was $660 into the battery. Today it's $4,700, right? So there goes, and then you get, I didn't have it on here. Let me just come back if I can. So then you get Ford saying, hey, Mustang Mach-E was profitable around $50,000. Now at $60,000, it's probably break even. Right? So if I'm an automaker and I can sell pickup trucks all day long profitably, 5 figures per each, but I got to break even on $60,000 vehicles, that's not such a great push. Then they control supply. There's a recall, can't sell them. So coming back to the first question, my point is there's the disruption of disruptors will probably be the legacy automakers. So here's that 6% is all pure play EVs, right? It really hasn't been contribution from the legacy automakers. So if you look here, and at the peak it's above 85%, the contribution in the US of the pure play EV makers, almost all of it is Tesla, right? Rivian and Lucid just came on the scene. The legacy guys, Mustang Mach-E, a couple of F-150 Lightning, Chevrolet Bolt, were a little bit in that. So here's our EV penetration, and it's really kind of picked up. But even still, that's 6%. And so here's the point, that this is controlled by the automakers. This is orchestrated by the automakers. That amber line is truck adoption, and that would include pickups, SUVs, crossovers, minivans, what have you. So in the time it took us to go from 0% battery electric vehicles to 6%, we've gone from 50% truck to 80% truck. And that number, and we will have electric pickup trucks and SUVs and whatnot. So that number will go higher. But it's interesting to me, and I always make the point that we think like consumers, right? The consumer's driving this. We want EVs, we want EVs. The automaker's not making them, and trucks are making them profit. This is what we get, right? At a time where we talk about EVs being the future, I'm sorry? Okay. Being the future, we're buying more trucks than ever, right? We were talking about this at dinner last night, right? And I'll get to it right here. So here's the mix, truck versus car. So the idea that we can go back to cars, they just don't exist anymore, right? We're 80%, we're going to 85, we'll probably go to 90. Ford, GM, and Stellantis' Chrysler brands are already well into the upper 90s. Ford's like 98% truck. There's one car left, Mustang, which is actually their best seller. General Motors' best-selling car in all of General Motors is Corvette, which averages $82,000. right? So there's nothing left to buy. There's no well, there is a Malibu, but they don't sell a lot of it. But there's no Focus, Fusion, Fiesta, Taurus, you name it, right? So as you look at this, right, and we'll talk about profitability a little bit, the legacy automakers really have the potential. So in the time that, and this is a cumulative pre-tax income number, and it'll include Tesla's federal tax credits, which regulatory credit sales, which is fine. It's part of doing business. So you can see that they just turned profitable at the end of 2021, cumulatively, and that number is like 11%, 11 billion. In that time that took Tesla to get to 11 billion, Toyota earned $250 billion, right? So my point is, the automakers will get to EV when it's profitable to do so. Largest segment in the US, full-size pickup trucks, right? Yeah, sure, we need them, two bags of mulch every season in the back. But it's not an accident, it's orchestrated, right? This is what's profitable for automakers. This is what they can make profitably. This is what is marketed, it's designed, it's manufactured, and this is what we get. And we're told that that's what we need, and it's rugged. And when EV is profitable, that it could be that segment, right? So here's midsize and compact car volume for GM and Ford, right? It goes to zero, and EV takes up the slack in terms of emissions and fuel economy goals. And here's the interesting point, what that mix shift in the US does, moving to trucks, and why automakers are orchestrating it. We're actually selling more $50,000 vehicles today than we did $40,000 vehicles in 2019. Not 10 years ago, just before the pandemic. So automakers have gotten out of the cheap cars, they've gone to the big trucks because it's where the money is. So when the time comes where EV is profitable, this is who are going to be the disruptors, the big, large automakers. Lithium carbonate, did we do that? So ultimately, that's my point about commodity costs wiping out profitability. Let me just scoot through there. So ultimately, those market caps, exorbitant market caps of EV companies are ready to be disrupted. The companies that are going to do it, and I know it's very maybe unpopular or unsexy to say, it's going to be the legacy guys. It's going to be the Toyotas, the company, General Motors, Ford, companies that have global scale of automotive manufacturing, distribution, after sales already in place. The change becomes, now we just need to make those drivetrains, right? So that's my time. Come see me after. I got my book. And if you want the slide deck. Thank you very much.
Thank you so much, Kevin. And I do encourage you to ask him any specific questions after. He's really great about answering. And now we're going to hear from our U.S. presenting sponsor, Invesco QQQ. Please welcome Ryan McCormick, Senior Factor and Core Equity Strategist at Invesco, in conversation with Lauren Keel, General Manager at Bloomberg Green.
Good morning, everyone. So good to see all of you. And Ryan, thanks so much for joining me.
Oh, thanks for having me.
Janet so wonderfully introduced you before we got up on stage here. But tell us, what is Invesco QQQ?
And I think after that long music intro, everybody is on bated breath.
They can't wait. What is it?
First question. So Invesco QQQ, besides what you see in the commercials every 5 minutes on most financial networks, is we like to joke that it's on the Mount Rushmore of ETFs. So it's the 5th largest ETF listed. It's the 2nd most actively traded fund in the world. And it tracks the Nasdaq 100 index. So it's made of the 100 largest companies listed on the Nasdaq exchange, ex financials. So what you get is this portfolio of 100 of the kind of most growth-leaning, very innovative, very kind of forward-looking companies that list on the Nasdaq exchange. And over the past 20 plus years that QQQ has had a live history, it's traded. It's really blossomed into one of the preeminent kind of ways for investors to access U.S. large cap growth.
You mentioned that QQQ is innovative. So actually, how would you define being innovative? Is there a way you quantify that?
Yes, and I think quantifying it is a very important notion, right? I mean, if any of you have heard me speak over the past 6 months, innovation is the most overused word of 2021. That's after unprecedented in 2020. But everybody's got the most innovative product, the most innovative strategy, the most innovative fund, but it's purely aspirational, right? We try to figure out a way that we can quantify why these companies seem to always be ahead of the curve. And I think it starts with their commitment to research and development. So as we start to look at the companies that make up the Nasdaq 100 index, we found that historically they commit more to research and development spend than their peers. And by peers, I mean companies in the S&P 500, companies in the Russell 1000 growth. And I think that commitment is an important one to note because an R&D spend in general is long term. Right? You don't throw money at an R&D project and expect that to be accretive to earnings next quarter, next year, even in some cases 3 years, right? This is decades long. I mean, cloud computing is a perfect example. I mean, the notion of cloud computing didn't really come about until about 2007, which is hard to believe that was 15 years ago. And just now it's starting to contribute to companies' bottom line. So the notion of R&D in general is very long term, and these companies, by their commitment, by spending more than their peers, I think have shown and fostered this culture of innovation and being able to stay ahead of the curve. The second step, or second way that we try to quantify innovation is we look at patent filings. So through our partners at Nasdaq and a research-based kind of AI firm out of Northern California, we look at patent filings over the course of 1 year periods. And over the course of May 31st, 2021 through May 31st, 2022, we found that Nasdaq 100 companies, or companies in QQQ, filed over 25% of patents around themes or disruptive technologies like big data, cloud computing, cybersecurity, 3D graphics. So I think that's really interesting to note because they're very active in this space of kind of themes and ideas that are just coming to fruition now. Right? They're just starting to kind of become a large part of our daily lives. So I think it starts with R&D. I think from there you can kind of take another look under the hood and the patent side of things. But I think in general that sort of is the fuel that drives these companies to consistently stay ahead of the curve.
And Ryan, what does all of this mean for investors?
Well, I think for investors that are looking for growth companies, these companies have shown the ability to grow. Over the past 10 calendar years, Nasdaq 100 companies have grown earnings, revenue, dividends at faster rates than, again, those competitors in some of these other indices. Beyond just the pure fundamental growth, when you're looking at growth companies, you're only as good as fast as you can grow. Right, so we need to look at the long term as well. So I'll go back to sort of the patent notion, right? 3D graphics, cloud computing, cybersecurity. Okay, we see that today, right? We see that when we log into our work computers. We start to see that in companies' earnings reports. But as you look at some of the other patents, there's things like bioinformatics, quantum computing, spacecraft and satellites, and I don't know which one of these themes is going to be a major part of our daily lives, but chances are it's going to be one of them. So you're seeing earnings growth today. You're also seeing the avenues to where that earnings growth will be coming from 5, 10, 15 years down the line. So I think that commitment to innovation ensures that investors are getting these growth-oriented companies where they're trying to invest in growth-oriented companies.
And could you leave us with one quick example of the individual investors? What are you doing for them?
Yeah, I mean, QQQ, we have over $150 billion in assets under management, right? It's the 5th largest ETF out there. So, we have a very diverse base of investors. We have institutional investors. We have a lot of investors in the financial advisor, the RIA community, and then all the way down to the individual investor. So we think this notion of financial education, which was talked about pretty extensively in the first panel, is imperative. And it needs to be approachable, right? You heard, it needs to be kind of digitally oriented. It needs to be approachable. They don't necessarily need kind of the white glove service. It's more of a, hey, how do I educate myself? So we've developed a game called How Not to Suck at Money.
I think we all need that.
Right, a catchy name. But it is a very easy to understand, it's a very approachable, it's an interactive game. And it's through it's in conjunction with our sponsorship of the NCAA. So QQQ is the official ETF of the NCAA. How Not to Suck at Money is the official financial literacy program of the NCAA. So geared towards more college-age students, it could be used for high schoolers. I've done the game. It could be useful for folks in their mid to late 30s. And it takes an approach that it's not, this is a stock, this is a bond, this is how we invest in it, right? It's looking at real-world financial examples. Hey, maybe this is what you should do with credit card debt. Things that were not necessarily taught in high school, in college, and beyond, and even in the investing world, right? I mean, folks know a ton about options when they're trading on some of these platforms. They don't really know how to effectively pay down credit card debt. So again, you can look at it at hntsam.com, and I think it's just the start of our commitment to the individual investor, the next generation of investors, and hope to continue this program for years to come.
Fantastic. Thank you, Ryan.
Thanks, Lauren.
Thanks.
We have now come to our final panel, and although we've been looking at the future investor, we know that investors of all ages are looking to add value to their portfolios, and increasingly, technology is coming into play. So please join me in welcoming Vincent Costa, Co-Chief Investment Officer for Equities at Voya Investment Management, Brooke Allen Forbes, Chief Investment Officer, Head of Technology for Personal Investing at Fidelity, and Sharmila Kassam, Vice President and Head of Asset Owner Solutions at Nasdaq. Good morning. Thanks so much for joining us. I'd like to begin with a bit of more about what you do. So in no particular order, I'm going to ask you just about your role in your respective institutions. Sharmila, Nasdaq was really a tech marvel when it launched 50 years ago. Can you believe that? February 8th, 1971 to be exact, as the world's first electronic stock market. Can you give us an idea of your role there?
Sure. So in the vein of the technology and innovation, and we got to hear a little bit about that from the QQQ as well, Nasdaq focuses on the technology and data that investors are using. So in my role as head of Asset Owner Solutions, I'm working with RIAs, OCIOs, high net worth, family offices, as well as the large institutions and sovereign wealth funds globally to try to help them invest using technology and data. And I know we're going to get into that conversation today, so it'll be exciting to share notes.
Yeah, in a little bit, I'm going to ask you how you manage those relationships. Vincent, Voya's foundings were tied to insurance, something that the younger generation does not think about very often as much as they should, and certainly not something that we associate with technology. So tell us about Voya's transformation from this ING subsidiary to actually an IPO.
Yes, good morning. It's really been a fantastic, interesting ride from, as Janet mentioned, being a bank-owned insurance company to a more independent health, wealth, and investment manager. We serve over 14 million institutional, individual, and workplace clients. So certainly a long way from just insurance business. I think the way it touches all of those clients really is through 401ks, health savings accounts, mutual funds, ETFs, and so a much broader array of products and solutions for clients. So it really has been quite an evolution over the past decade.
Brooke, Fidelity is a third-generation financial giant in our respective hometown of Boston. It has also undergone extraordinary innovation. Give us an idea how technology is leveraged by and for the individual investor, since that is your area of concentration.
Absolutely, and good morning, and thanks for having us. At Fidelity, to your point, we've been blessed. We recently celebrated 75, now going on 76 years being in business. And part of that in business, we serve 35 million customers. We also serve 23,000 additional businesses through employer benefit plans and support another 13,000 financial institutions. We, on average, invest about $2.5 billion in technology on an annual basis, and 25% of our workforce, and growing, is actually in the business of software engineering, digital engineering, design, architecture, and creating product. We would be remiss to say that the entire business is fueled by technology. And when I say that, that for us really means two things. One is technology that serves the individual investor, all of our digital channels. But given that we believe very much, as we talk more about personalization today, in both the human channel as well. So that's also technology that our associates and client-facing advisors are using. So pretty significant. And in my role as Chief Information Officer, I'm really blessed to have an incredible team that comes in every day figuring out how can we serve that diverse customer base.
And speaking of the customer base, Fidelity, I know, saw a huge increase in new accounts that opened, especially during the pandemic, as most institutional investing houses did. We'll go into that in a little bit, but Shar, I want to come back to you to ask you about those customers. Can you give us an idea of who those institutional customers are and how you service them increasingly using technology?
Sure, so happy to. At Nasdaq, when I talk about allocators and asset owners, what I'm speaking about are the pensions, the university endowments, the RIAs that I know some are in the audience and across the Bloomberg network. So we're looking at all different types of allocators who are looking to work with asset managers as well as get into the capital markets through either public or private investments. We have about $2 trillion under analysis in that realm. And with that, we try to remember exactly who they're also serving, giving them tools so that they're pursuing their missions, whether it's a retirement or actually sponsoring something for research and an endowment.
Speaking of retirement, which is something that we all think about, and actually, as we learned today, even the younger investors are starting to think about this earlier, which is only good for them. I'm going to ask Vincent a question, but feel free to jump in. Vinny, you, of course, service a lot of 401k retirement plans. What do you wish would be different or improved with that investment vehicle?
Well, we've seen a lot of improvements even over the past few years from things like automatic savings rates and automatic enrollment, customized advice for 401k participants, the potential use of other vehicles like annuities in those plans, and sustainable investing. So there's already been a number of innovations. I think one of the things that I'd like to see is continued flexibility for our 401k clients, where they have sort of more flexibility to go sort of outside even the investments that are prescribed there. So I think as we go forward, we're going to see a lot of those kind of enhancements as they go forward.
Now, I know that each of you in your roles, you're not responsible for personal interaction directly with your customers. But since we are talking about the next generation of investors, I'd like to ask each of you if there's something that you see or that occurs to you that actually makes this newest generation different from, say, the current and legacy investors.
Yeah, I'm happy to start with that. It's a total passion point for me personally. One of the things that I observe, this particular generation at Fidelity, when we say young investors, what we're talking about is really that demographic that spans between 18 to 35. So that's going to be Gen Z, Gen Y, a little bit millennial. One of the most socially conscious, financially curious, well-educated generations. Now, no doubt, they're growing up in a proliferation of technology availability that other generations didn't have. So it means education's much more accessible. But the actions that we're seeing in this generation in terms of not just getting educated, but actually taking the action to get invested, to be curious about planning, to be, we've talked a bit about today in terms of how to balance, it could be student debt and also, that first sort of significant purchase, whether it's a car or, your next degree. it has been really striking for us.
And we also know that Fidelity, I think fairly recently, allowed a much younger class to open accounts. There are appropriate guardrails. I think you need the adult over 21 to be a co-manager, but something that we wouldn't have thought about at 14 or 15. Shar, what are some of the things that you're observing with the younger investors?
Sure. So I think we see it, and actually I get the chance to talk to investment teams who are often, the intergenerational wealth is changing. So when you're looking at family offices, you've got investors that are of this generation, and they're trying to think through, because they are the I generation, they've always grown up with data and technology being at their fingertips, how they actually are taking investments and transparency and looking at data in ways that we could only hope to do because of the development of technology in such, the recent several years. I think the other thing that we're seeing too is that they're demanding certain things. So we've talked about sustainable investing for decades. I know as an institutional investor myself, we were always trying to look at that both from a risk management or even leaning in for returns. But I think what you see now is you're seeing investors coming up looking for certain types of impact or mission they can do. And so anything from investing in diversity or investing in governance, we're seeing a lot more demand, and we're seeing that translate from this younger generation.
Vinny, I know that you're going to answer this question, but I also want to bring in, because you do a lot with artificial intelligence, and I know that this is something that's a word that's still intimidating to a lot of people of a certain age, and it's something, though, that the younger generation and even other ages, they're being more comfortable with it, and they realize that it's going to be a part of how we invest in the future.
Yes, and I think, so my role is to oversee our equity investments, so whether, again, they're mutual funds or institutional accounts. My background is more in quantitative investing, so I've always used data and technology and modeling to help make investment decisions for our portfolios. I think what we've seen really in the last decade is the influence of AI, machine learning tools, to further enhance that capability and allow us to hopefully make better decisions for our portfolios and generate outperformance. So just as an example, Janet, a couple of years ago, we acquired an AI machine learning firm and brought them on board. And what we've seen in the couple of years they've been there is not only can they generate better returns and than we could have previously in our quantitative investments, but they work very closely with our fundamental teams who manage money in a more traditional style, and even our quantitative teams that have more model-driven. So I think the proliferation of AI in the investing world is incredibly important. I think it's just going to continue, and I think it's going to be a benefit for investors for a long time.
When I introduced the event this morning, I talked about that we would look at different asset classes and what all generations are finding interesting. We got a great question from the audience for all of you. Since future investors want to invest in private markets, what makes a successful private market? And I think I'm going to start with you, Shar, because he asked, why did Nasdaq get out of private markets?
So we did get out of certain aspects of the private markets business, as some people know, and there was a spin out. But we're actually very much involved. Much of the data that I collect through eVestments and Solovis, which is a platform for portfolio management, is based on the fact of using public market and private market data and helping you understand portfolios. We also have other aspects of Nasdaq where we're looking into, again, along the same themes here about how to make information accessible across stakeholders. So in the private markets for secondaries, we're actually developing platforms where we can help asset managers and investors come together. And that also translates from institutional investors across to retail, because we know there is a desire for many to diversify their portfolios. And now with the use of technology and being able to scale, we're able to do that in a way that wasn't possible before for retail.
Mm-hmm. Brooke, I want to ask you, during the pandemic, as I referenced, Fidelity had several million more new account holders, a lot of them young. They had the relief checks, they had time. First of all, have those investors generally remained active?
Not only have they remained active, they're still coming to join our platform, and that's evidence that in Q3 alone, almost half of our net new retail account openings were in this demographic of young investors, 45%. The other thing that really struck me personally and struck us, that 83% of new IRAs were also by this demographic. That is an increase from the same quarter a year ago. So I think those are pretty powerful statistics. The IRA one in particular, to me, what's really telling about that is my point earlier that this generation is taking action. It's not just about the education, but it's actually taking that step forward. And, given, as we were talking about the retirement industry, right, which is much more about long-term planning, to see a younger generation take action so early in their life, thinking more longer term. I mean, I certainly, am embarrassed to say that was not me at that age. And so just, really, really terrific. And I think, the industry overall is doing a great job to continue to democratize.
You said you're embarrassed it wasn't you at that age. I'm depressed it wasn't me at that age. Yeah. Because I see my nieces and nephews opening accounts 14, 15, already starting to think about their first house at 2021. And I'm thinking, okay, so much smarter. By the way, Fidelity just launched its crypto platform. I know we're not in the crypto space, but it seems like this is something also that's always going to remain an option that they demand, along with other asset classes. They generally expect more.
Yeah, I think, for us here at Fidelity, constantly ensuring the power of choice, and whether that choice is in product selection. I really appreciate what you were saying earlier, thinking about how, the retirement industry and how this generation will think about retirement, having power of choice in that, and having power in how you want to do business, which is about choice of channel is also, I think, increasingly important.
I want to ask you each about how the pandemic affected innovation at your firms, because we saw the increased digitization everywhere. Also, as a reminder, as industries change, they grow, they decline. We saw with the EV presentation that those trends change. But finance is constantly growing, no matter what. It's something that we all need. So let me start with you, Vinny, on how the pandemic impacted what's happening at Voya.
Yeah, so pre-pandemic, it'd be almost, and I'm talking pre-pandemic, 2 weeks before the pandemic, we would never have imagined that we could all work successfully together virtually. It just was not even on the radar. We had, sometimes you would work home or if you had something going on, but it wasn't really as pronounced. And then a couple of weeks in, all of a sudden we're collaborating, we're working together. And so I think this whole, and now 2 years later, obviously there's sort of this hybrid, semi-remote type of workplace, but it works, and it works really well. And our employees, our teams have gotten used to it. There's no substitution for face-to-face, but so many things that we can do that we didn't think we could do before virtually, we're doing, and it's working.
And Shar, I want to point out that in the early days of the pandemic, perhaps not so much for Nasdaq because it was already very tech forward, but we were wondering, are the markets going to continue? How are we going to make these things happen when people can't be there physically? I know that this must have been a time of high stress for you.
So across the organization, obviously we power many of the stock exchanges globally, so over 130. And obviously we were trying to think about it from a very global and inclusive perspective. So I think the other aspect of that that's a natural follow is the investors were trying to figure out how to look at those markets. And many had to rely on things. Yes, face-to-face is better, but they started looking at how can they leverage the data, how can they exchange information, how can they be connected and be able to have insight into their portfolios from a very detailed transparency standpoint, because we were very uncertain where things were going, from supply chains to just the pandemic in general. I also think, in addition to us really leaning in more, and probably as a momentum for our investors were seeking different insights from us, we also looked internally and were very introspective. So, I think I would echo the comments of hybrid work environments have really challenged and maybe even expanded our ability as organizations to grow. But in terms of investments, a lot of what we do is about workflow. And so Nasdaq spent some time really looking at how we do our workflows and trying to optimize. And that's one of the areas I've always found interesting about technology and investments, is that you can have the best investment strategies in the world, but if you don't have those operational efficiencies, it really can challenge the end results. So I think that's something we've learned internally, and we're looking to bring that to the customers as well.
Brooke, also Fidelity had to stay online as we saw this huge surge in demand with people at home investing. And I know several times over the past few years, since the start of the pandemic, Fidelity has announced plans to hire like 10,000 people to help service all these new accounts. But in your role in technology for personal investing, I want to ask you about how you're interacting with all these customers. Is it more virtual? Is it no longer my generation, or perhaps a little older, where we'd actually call up our advisor?
It's a great question. So first, let me comment. You're absolutely right. We've hired almost 30,000 people since the big pandemic began into the complex. And what's interesting about that is, almost 5,000 of them are certainly in the business of technology delivery, but many of those roles are actually client-facing, which brings me to really talk about this channel of choice and what we mean by personalization. So, Janet, a couple of things happened in the pandemic. Number one, for all of us, right, money has emotion tied to it because it's decision-making. It's very personal. So a couple of things. One is we amped up significant investment. You talk about digitization of service. The things that you don't need, you want to get done quickly, we need to be available digitally. So major investments, we revamped our mobile platform, significant investments in our web platform, virtual assistant. How do we make it as easy for all of our customers to do business with us? On the other side, while we were hiring more client-facing roles, people were actually calling us, which is why we needed to, be there for them and actually hire into the complex. Why is that? Because there were a lot of, really difficult life moments in the pandemic. There was a lot of hardship in the pandemic. And those are really, in our experience, personal conversations. And then, of course, because we were all virtual in our investor centers as well, in that case, what was really great for us and helped us scale our business was that we were able to meet with clients virtually, right? You couldn't come into an investor center. So now as we kind of look forward, that has really scaled our ability to meet with customers in the channel that they want at a moment of need. And the other thing that we've learned is, each one of us is unique. So how we want to do business, what you might want to do on a mobile device could be different than an in-person conversation, could be different than an extended platform. And having that kind of flexibility to really meet a diverse set of customer needs is something we really leaned into in the pandemic.
We are now down to our last 5 minutes of this panel and of this morning's event. So I would like to ask each of you, I'll start with you, Vinny, about the horizon, the challenges that you see coming up, and how you think your business will evolve in the next 5 years.
Yeah, we spent a lot of time thinking about that, Janet, and I think we started touching on some of the technology, and that's why I was so interested to be here today. I think when it's not only importing and developing new technology to help our clients win in terms of our investment performance, it's about how we utilize that technology across the whole platform. So it's for example, not just an AI, machine learning driven fund, but how do we use those tools and techniques to drive better performance across our whole platform for our clients. And I think we spend a lot of time now thinking about the next 3 to 5 years and how that's going to evolve in a world where we might have virtual analysts sitting next to human analysts, and I think it's really exciting. I think it's a world that's opening up to us more recently, but certainly in the last decade has really taken off.
And we should also remember that as we bring in these technologies, the best technologies are almost hidden. They run without people really noticing them, and they do hold the promise of improving the job experience for everyone who works at these respective firms, because hopefully the jobs will become less tedious. Shar, with Nasdaq having to deal with so much information on a daily basis, I know automation was part of the founding story of Nasdaq and will be so in the years ahead. What sort of evolutions do you see coming at the exchange?
Sure. I actually believe, building on what's already been said, it's going to be about the analysis itself. We're talking a lot right now about artificial intelligence and what you're saying, that we're going to have virtual analysts alongside the human capital that works in the industry. But I think we're spending time also thinking, I think in the horizon it'll be, you've got data coming in from all different sources. You've got some data that is sustainable or ESG related. How do you analyze that in a way? And how do you take it across different types of asset classes that have yet to be developed? So I look forward to spending just as much time as we're talking about the technology developments as much as what we're doing with the impact of that.
Mm-hmm. And Brooke, something that has happened at Fidelity, if you own an account at any investment house, more and more information is being given to the individual investor. I didn't think 30 years ago, I'd look at the entire book of a company and their debt and their earnings and going back several years, who else owns them, et cetera. And this is something that it appears that there's going to be more and more information available in the future, too.
100%. I think as we were talking earlier, Vinny, you were talking earlier about the power of AI. So a few things about the future. Number one, to your point, Janet, I think the proliferation of data will continue. What's important about that is two things. Number one, speed of information, where I think, AI powering that becomes really critical. But number two, insights. It's not just about the information, but how do we create personalized insights for investors that are real time? The second thing, just as we think about the future, I mean, if we've learned nothing in the last 3 years, I speak for myself, how unpredictable and just fragile, right, the world is. And I think we still have a lot ahead of ourselves in terms of geopolitical climate and world conflict. We have the elections coming up. The point being that there will always be unpredictability. But the criticality of education, having a plan, and having somewhere that you can go, right, to have those conversations and make decisions are things that we have really found to be most critical in actually helping to get through that unpredictable volatility. So a little bit of expect it to continue, but how do you sort of plan for that future and then have the knowledge real time at your fingertips, which is where the power of technology comes in, so you can make decisions that are best for you and your loved ones.
Mm-hmm. Thank you so much. We are at time. I really appreciate your incredible insights today, Brooke, Sharmila, and Vincent. Thank you so much for joining us.
Thank you.
Thank you.
Thank you so much. And that actually does it for this morning. Boy, that went by fast. I learned so much myself, even from this seat over here, and we are so grateful for you to be here. I want to thank our terrific speakers and our U.S. presenting sponsor, Invesco QQQ, for making this briefing possible. If you'd like any more information from our sponsor, just go to the Resources tab on the event website. And you can also watch any part of this event again by returning to BloombergLive.com, the Future Investor 2022 on demand. Please join us as we continue this series in the new year. We will be in Chicago on January 24th. For more details, you can register to be in person or to join us virtually. You can again visit BloombergLive.com. And I want to thank everyone joining us virtually from around the country and the world, and for all of those of you in this room for being such a terrific and engaged audience. Happy holidays.